There is a single chart, simple, almost boring at first glance, that has flagged the last 8 recessions in the economy. 8 out of 8. With 0 false alarms. It is the yield curve. But before I tell you why it predicts recessions, you need to understand what it actually is, because it is far simpler than its reputation makes you think. The yield curve is a chart, nothing more. It has 2 axes. The horizontal axis, the one along the bottom, is maturity. How long until the government pays you back the money you lent it? When you buy a government bond, you are really lending, and the government commits to paying you back on a specific date. That date can be very close or very far away. 3 months, 2 years, 10 years, 30 years. Those are the terms you will see from left to right. The vertical axis, the one on the left, is the yield, the annual interest rate as a percentage that each of those bonds pays. The higher a point sits, the more that bond pays you. Now you plot 1 point for each maturity, at the height of what it pays, and you connect the dots. That line is the yield curve. Think of it like the profile of a road seen from the side. The horizontal axis is the distance you travel, the term, and the vertical axis is the height of the ground, what you get paid. The only thing you are going to watch in this whole video is whether that road climbs or drops. Normally it climbs. That is what we call a normal curve, an upward slope. Long-term bonds pay more than short-term ones. Why? Because lending money to the government for 10 years is more uncertain than lending it for 3 months. 10 years is a lot of room, for inflation to change, for growth to change, for everything to change. So investors demand extra yield in exchange for waiting that long. Time charges a toll, and that toll is what tilts the curve upward. When the curve climbs, the world is, let us say, in order, and then, sometimes, the curve flips over, a downward slope. The short end starts paying more than the long end. It is the world upside down, and it has a name, an inverted curve. How do you get there? Here it helps to recall something we saw earlier in the series. There is not one interest rate, there are 2. The short rate is set by a committee, the Fed. The long rate is discovered by the market, and those 2 ends of the curve do not always move together. The Fed fights inflation by raising the short-term interest rate. When it raises that short rate, it lifts the left side of the curve, the 3 months, the 2 years. That side obeys the committee. Meanwhile, the other end, the long end, looks to the future. And if the market expects those high rates to end up slowing the economy, the 10-year yield stays put, or even falls, anticipating that in the future rates will have to come down again. So the committee pushes the short end up while the market lets the long end fall. The result, the short end above the long end. The curve inverts. Let us pause here, because this is the part that takes the most effort. Why would anyone accept less yield on a 10-year bond than on a 3-month one? Because the investor believes there will be even less tomorrow. Locking in a lower yield today but for 10 years looks like a better deal than collecting more in the short term and then having to reinvest at rock-bottom rates. That downward slope, that curve dropping instead of climbing, is exactly the warning sign. And the key point, employment and growth do not collapse at the same moment the curve inverts. They weaken afterward with a lag. The curve warns first. And here comes what I promised you at the start. The difference between what the 10-year bond pays and what the 3-month bond pays has a name, the spread. When the long end pays more than the short end, the spread is positive and the curve climbs. When the short end pays more than the long end, the spread turns negative, and that is the inversion. Well then, that spread between the 10-year Treasury and the 3-month has anticipated 8 of the 8 recessions since the 1960s. 0 false signals. Let us go through them one by one. The one from 1969 to 1970. The one from 1973 to 1975. The one in 1980. The one from 1981 to 1982. The one from 1990 to 1991. The one in 2001. The one from 2007 to 2009. And finally the one in 2020. 8 warnings. 8 recessions. And this is not market folklore, nor a coincidence somebody drew in after the fact. In 1986, Campbell Harvey proved it for the first time in his doctoral dissertation at the University of Chicago. He tied the curve spread to future recessions. Later, the Probit model of Estrella and Mishkin at the New York Fed went even further and beat as a predictor both the Commerce Department's leading indicator index and the stock market itself. Put another way, This simple line was right more often than the big dashboards of indicators and more often than the stock market. The New York Fed still maintains to this day a recession probability model built on that same spread. Let us review the 4 most recent episodes, one by one, with their exact lead times. First, the curve inverted in 1989. The recession arrived in 1990. 13 months of warning. Second, it inverted in $2,000. The recession arrived in 2001. 13 months again. Third, it inverted in 2006. The crisis broke out in 2008. 22 months of warning, the longest of them all. And fourth, it inverted in 2019. The recession arrived in 2020. Only 6 months. An outlier because what triggered it was a pandemic. 4 inversions, 4 recessions. Every time the short end overtook the long end, the contraction ended up arriving. No exceptions in this record. Now, a nuance a professional never overlooks. Which spread you measure matters. The one with the clean record is the 10-year minus 3-month. 8 of 8. 0 false alarms. But there is another widely cited version. The 2-year against the 10-year. And that one did give a false signal. Just one in 1998. The curve inverted and the economy did not go into recession afterward. Same object, 2 different measuring sticks, and only one of them has the perfect track record. When someone says the curve is inverted, the first question is, which one? There is one last subtlety that separates understanding the curve from believing you understand it. It is called the term premium. It is the extra compensation you demand simply for holding a longer bond. The toll of time we talked about at the start, now with a name of its own. Remember, lending for 10 years is scarier than lending for 3 months, so you ask for a premium to bear all that time. That premium is the term premium. The problem is that the spread you see on the chart blends 2 different things into a single line. On one side, what the market expects rates to do in the future, and on the other, that term premium. They do not come separated, they come added together. That is why a compressed term premium, that is, a small one, can flatten the curve for reasons that have nothing to do with a recession. The curve moves closer to inverting, but not because the market fears a contraction, rather because that premium has shrunk. Telling how much of the curve is expectation and how much is term premium is fine. Careful work. And untangling exactly what pushes that long rate up or down is worth its own chapter, which it will have later in the series. And now the honest fine print, which goes only here, at the end, and never at the start. First, the lead times vary between 6 and 24 months. It is not a precision stopwatch. Second, the NBER, which is the body that officially dates recessions, always does so after the fact, with months of delay. Third, the un-inversion, that is, the curve steepening back toward normal, tends to be the real trigger of the recession, more than the inversion itself. And fourth, even Harvey, the man who discovered all of this, warns against blind faith in any single indicator, however good its track record. It is the best warning we have, not a crystal ball, and a warning is used to prepare, not to guess the exact date. Let us recap in one sentence. The yield curve is a chart of yield against maturity. When it climbs, the world is in order. When it drops, when it inverts, history has learned to listen. Not because it foresees the future, but because it sums up in a single line what the entire market expects to happen. If we have made the ideas clearer for you, subscribe to the My Best Wealth channel. We analyze, you decide. This is educational content, not a buy or sell recommendation. The yield curve is a framework to understand, not a prediction. Your numbers, your horizon, your risk.